Hi, good day everyone, and welcome back to lesson number 21. Today we'll be taking a look at working capital, which is part of chapter 5. So, under chapter 5, we'll be taking a look at working capital and cash management. So, for the first part of chapter 5, we're going to focus on the working capital management, which I will explain uh, soon once we start with the lesson. So today's lesson will be covering page 219 to 224 of your textbook, Finance in Media 4th edition, published by Edge Education. So please make sure that you also watch the recordings that have been, which the link have been attached to this PowerPoint. And another thing that you also need to remember, the importance of attending classes regularly and making sure you participate during class so that you get to understand the concept much better, and also making sure that you complete textbook activities that have been covered in each and every lesson that we're going to do under this lesson. So under this lesson, the lesson outcome is that we are going to cover the net working capital. We're going to cover the main importance of working capital, the relationship between risk and reward, also known as risk and return. And then we're also going to talk about overtrading. So those are the things that we are going to cover under today's lesson. So the learning outcome is that by the end of the lesson, you should be able to understand the net working capital, understand the three main current assets, understand the relationship between the risk and reward, and overtrading. So this is what we are going to do today, and make sure that you understand the concept and you have and also understand the application of this concept. So with today's concept, it's all about working capital. So working capital, this is the amount of money that is needed for to run the day-to-day operation of any business or project. So in a media industry, we always also need working capital. So any industry or any company, especially in the media company, working capital is required as part of the business operation. So when we talk about working capital, so this kind of capital gets to be financed through short-term borrowing. Some of it can also be financed through the capital that the business owners provide, which is the ordinary capital. So, but in most cases, when it comes to working capital, so what actually happens is that our working capital most of the time gets to be financed by the amount that we still have remaining after we bought all our assets. Those are non-current assets, and then we also top up some of those assets using short-term borrowings. So those are our working capital. So working capital refers to the current assets that we actually hold within the company that we're gonna use as part of business operation. Things such as our petty cash, which we use it for change, the cash that we already hold within the company that we use it to change for customers, buy mini stuff that we're gonna need in the offices, things such as our inventory that we're gonna need to sell on a daily basis to generate revenue, items that we're going to need for us to be able to render services to our client. So all of this falls within current assets. So those are our working capital. So all the money invested there, we refer it as working capital. So that is the money that we're going to use to finance the business day-to-day operation. So the moment we talk about the terminology net working capital, now we are referring to where now we get to take a look into the full picture to say that from the assets that we bought to run our day-to-day operation, we bought these assets through short-term debt, which is our current liability. So therefore, for us to be able to identify how much net working capital we have, we are going to take a look at our current assets minus our current liability. So meaning that we are saying that if our liabilities become due, we will be able, how much of our current assets will be able to cover that, and whatever will be left with will be our net working capital. That will be what we're going to be working with as part of the business day-to-day operation once we have paid off our liability. So we refer that as net working capital. So most of the time we get to assess when we plan for the business or for the financial period of a business, we also take a look in terms of the working capital, how much working capital will be required and how much net working capital are we going to have during this financial period that we're gonna use to survive or that the business will need to survive and continue to operate. So that's what we referred as net working capital. So in the previous lesson we did cover some of the concept in terms of liquidity, in terms of profitability, the ratios, which ratio will be used to understand how the business is currently performing. So some of those ratios, we also refer them as our liquidity ratio or working capital ratios. So under the working capital ratio, we are talking about your current assets to current liability, such as the current ratio. So the current ratio also represent the working capital within the company to say that in terms of the current assets, this is how much we have, and if we pay off our liability, this is how much will be left off to continue the operation of the business. So that's why the norm is 2 to 1, to say that once we pay off our liability, we still need something as part of working capital that we're going to use to work with on the daily basis of the business, also that the business can continue to operate. So here on the slide, it says that the net working capital is the difference between a company's current asset, such as cash account, receivable, inventory of raw material, and its current liabilities, such as account payable and debt, which are short-term debt. So here it continued to say that current assets are also known as working capital. These represent the assets of the firm that circulate from one form to another in an ordinary course of the operation. To say that working capital refers to the amount that we went and borrow for short term and use that money to finance the short term assets of the company that we're gonna need on a daily basis, which we're gonna use those assets and transform them into cash or invest them again and then transfer later them into cash, such as our trade receivable. So when it comes to trade receivable, what happens is that we transfer our inventory into debt, where the debt are the people that actually get to owe us, and then later on we go and collect from those people. So those are what referred as working capitals. So we need those people to actually run the business. We need inventory to run the business. We need cash to run the business so that we can be able to afford whatever might be needed during that particular moment when running the business. So also need things such as your PT cash. So those are referred as current assets. So that's what we call working capital. So the capital that is provided by our debt providers, which is then used to finance the business operation by buying small current assets that we're gonna use for the business operation. So here it says that there are three main current assets that we are familiar with or that are most commonly used when coming up with the working capital. We've got inventory, and we've got trade receivable, and we also have got cash. So those are the three major roles within the working capital of a company. So when we talk about the current assets, these are the most common type of assets or account that we're gonna focus on. So here it says that the greater the margin by which the firm's current assets cover its current liability, the easier it will be for the firm to pay its bills as they become due. But in the previous lesson, we did talk about a C-test ratio, which I did mention that for the business to be able to succeed or for the business to be able to operate efficiently, it needs to make sure that even though without the use of inventory, the company can still be able to cover its current liability. So meaning that those investment in the trade receivable and the amount of cash it have, it needs to be sufficient enough to cover the current liability, meaning that once it covers those, they can then use inventory as part of their operation or as part of their working capital and continue to operate and sell them to generate more revenue. So meaning that the part of where the business become insolvent, it will not come into existence. So insolvent, I explained earlier on that on the previous lesson that this is when a company is unable to pay its long-term liabilities. Then this brings us to now to the part of the risk and reward. So this one I'll also refer it as a risk and return, to say that for every investment opportunity that one gets to take, we expect you, or you expect to actually be rewarded for taking that risk, or you expect a return in terms of your investment. So here it says that for each and every risk that you take, you would expect a reward. So we've got different types of risk takers that are not listed here. So we've got what we call an averse risk takers. Those are risk takers that will take risk up to a potential level. And we've got the risk taker. So risk taker are those who will take risk as long as the risk is high and there are higher potential return. Those guys will take that risk. So they do not have a preferred option as long as the returns are there and they are very high as the risk. So therefore they will actually get to take that. And we've got neutral risk takers. Those are the guys that will say that no, I will only take risk as long as I am guaranteed my money. So those guys will not take risk that they will not go and invest somewhere where risk have been calculated and found to be inexistent, and there is a guarantee that they might not actually get their reward. So meaning that those are the people that will not invest. So those are the type of things that you as a person in media, you need to understand that there are some of the media industry or media companies that when you go into them, you are actually going to take a risk. And when you take a risk, you need to understand the type of reward that you should expect based on the person that you are, what type of a risk taker that you are. So in terms of risk have been identifying as the degree of uncertainty for potential financial losses inherent in an investment decision. So in a simpler form, I will say risk is the uncertainty of future event that might actually occur. To say that we are saying that there is an event that might happen, but we are uncertain in terms of the outcome of that event. So that is the definition of risk that I can simplify it to. So here we've got three types of risk when it comes to a media company. We have got what we call a business risk. So this kind of risk refers to the possibility of commercial business making inadequate profit due to uncertainties. So this kind of risk can be eliminated or reduced to a zero level. And then we've got non business risks. This type of risk refer to uh, the risk that do not derive from the product or services supplied by the business. So those are risks coming outside of the business, things such as strikes, things such as floods, things such as political issues. So those are risks that can affect the business and are not associated with the operation of the business. So we call those non-business risk. So those kind of risks, we cannot eliminate them. We can just only be prepared for them, unlike business risk. And then we also have got the last one, which is financial risk. So when it comes to financial risk, this one refers to your business ability to manage your debt and fulfill your financial obligation. So when it comes to this one, for you to be able to mitigate this risk, you need to plan properly in terms of how you're going to spend your finances and how you're going to receive capital and the utilization of that capital. So meaning that in terms of financial risk, there are financial risks that we can actually minimize and there are one that we cannot minimize. In terms of, for example, let's say we've got a loan with the bank which we have used to finance our operation, and then some political issue came in, or inflation goes up. So we also expect the interest rate of that loan to actually get to go up. So those are some of the financial risks that we might actually account in terms of running the business. So in a media industry, so these are all types of business risks that you get. These are types of risks that you can actually come across. So when you get to assess the business risks, so if you're trying to invest into a media company, it is important that from understanding of our financial statement in the previous lessons, and as well as understanding the ratio, you also need to assess the risk in terms of what that company actually hold. Then from that point, you will then be able to give or assess the reward in which you are going to receive after investing in that particular company. To say that if this is the risk that the company is saying, or this company is exposed to the following risk, and there are no mitigation in place to say, or there is no process that are being placed to actually get to minimize this risk. So therefore you will also expect the reward to be very high of that company, because you are taking a full risk compared to a company that you know that it has got limited risk. So meaning that if the company have got limited risk, you will also expect the return of that company to be a bit lower. So that is all in terms of relationship between the risk and reward, is to say that for every risk that there is, it is there, the higher the risk, we expect the higher reward. So in terms of a reward, here it says that reward, it is the total income an investor gets from his or her investment every year, and it is usually counted as a percentage of the original value of the investment. So in the previous lesson, we talked about the return on average owner's equity. So if you're going to invest into a media company, and then when you invest, your return will be measured against the net profit that you are going to share with other capital providers or owners of the business, or partnership, or your partners. So therefore, we're gonna quote, or gonna calculate the net profit, will be quoted as a percentage of the ownership or average ownership capital provided, to say that how much of the capital are you actually guys actually getting to receive back as a return, and then we're gonna split that after you actually get to receive it. So here it says, to understand the relationship between risk and return, we're gonna take a look into this under the working capital. So under the working capital, it says that the working capital ratios, which is the level of current assets as a percentage of current liabilities, it can actually tell us a lot about a media firm's profitability and its risk profile. So when we get to assess a media company, we're going to take a look in terms of its current assets, and see to say that based on the current assets of this company, how much can actually get to cover the current liability. So we're going to perform a working capital ratio, which is the current ratio, to see if how many times can our current assets cover our current liabilities. So this will determine the risk of that particular company. So if the current work ratio, or the working capital ratio, indicates that um, our assets, or our short-term current assets, can only cover one times the current liability. So it means that after, if those liabilities become due, the business will not have anything remaining to actually get to finance its operation. So meaning that the business will cease to operate, and therefore that will be the collapse of the business. So it is important that when you invest in such company, you assess the working capital ratios, which include your current assets ratio, to measure if indeed this company does have enough assets and will be able to pay off its liabilities. So the risk there will actually be the assets being lesser than the current liability, or current assets being equal to current liabilities. So that poses a risk. So meaning that when investing in such company, or if you are a manager within that company, you need to be able to pick this up and be able to solve the issue as fast as possible, and make sure that you maximize the current assets and minimize the current liability of the company. Another thing is to say that the higher the current asset level as opposed to current liability, the lower the risk of the technical insolvent, meaning that if the liabilities become due, the current assets will be enough to cover that. So meaning that the insolvency part, where the business is unable to pay back its a long-term debt, or its debt, will not be inexistent, will be lowered. So meaning that this company's continuity and operation is not at risk. So therefore, when you invest there, you will expect that you will actually get to receive lower return, because the company is not at risk. But if you are going there, you're a manager, you will notice that this company is actually at risk. So if you were to manage that company, or they were giving you the position of a manager, you will expect a higher return, because there is a lot of risk. Or if you're an investor, there is a lot of risk of that company defaulting and not being able to pay all their creditors. So here it says that therefore, the higher the working capital ratio, the less profitability the business will be. So when it comes to this part, what we are saying here is to say that if you have got a higher working capital ratio, it also indicates that you have got too much amount of cash invested into your inventories, meaning that If you have got too much cash invested into your inventories, it will take long for the business to actually get to convert those inventory into cash, because they will need a lot number of clients. So therefore, meaning that this poses a risk of profitability toward the business. But in reality, this is not almost all the case. So here this is the basic of investment principle, to say that if you have got too much higher working capital ratio or current assets ratio, it means that too much money is invested into current assets, which most of them you will find that it is inventory, and it might be difficult to actually get to sell inventory. Sometimes your stock might become obsolete or it might become outdated. So meaning that that also poses a threat. So therefore profitability becomes an issue to that company. So meaning that when it comes to that, it says, however, there is a positive relationship between risk and reward, which is to say that the higher the risk, we expect a higher potential reward, and vice versa. To say that if there is lower risk, we expect lower return. So also when managing a company or trying to invest into a media company, these are some of the things you have to take a look into, to see is how much risk does my company have, and what does this pose as a reward towards my investor. So those are some of the things you need to consider when it comes to the relationship between risk and reward, which is also known as risk and return. To say that for every risk that you try to take, you expect the return to be more than the risk that you're actually taking. And then this brings us now to what we call overtrading. So overtrading here, it says that for each and every business that have got enough current short-term current assets, or that have got higher current working capital ratios, there are many pitfalls associated with managing this working capital, and one of them is known as overtrading. So in the terms of overtrading, this is means that you are growing your business too quickly to detriment of the working capital, net working capital. So meaning that you are investing more money in the current assets, and which is inventory, and meaning that you will actually get to grow the business too quickly to a point that you will run out of clients, because all your clients will now be having your product, and that will be over trading. So meaning that they will reach a point where your company will actually get to your sales will decline at a faster rate, because there's no longer a market for you, because you have closed all the gaps of the market. So meaning that when it comes to running a business, you need to make sure that you do not overtrade. You allow enough demand for your specific product. So here it says that overtrading, this happens when a business decides to buy more and more inventory on credit in order to increase sales, but has difficulty in selling this merchandise in the time, or collecting cash from trade receivable timelessly. So meaning that you end up either having your inventory and managing to sell it, but having issue trying to actually get to receive, collect or to collect from your debtors. So this becomes an issue. So this is what we call over trading. So when you just have got higher sales or higher credit sales, but you are unable to collect cash from your trade debtors. So here it says that the negative effect of overtrading becomes worse when trade receivable collection period is collection period exceed the trade payable settlement period. So on the previous lesson, I explained that trade receivable collection period determines how long you take to actually collect money from your customers, and trade payables determine how long it takes you to pay back your creditors after buying or after them supplying you with stock on credit. So therefore, we expect the receivable to be much lesser compared to settlement period. But if your collection is longer than your settlement period, meaning that you are running out of cash before you even collect, so this also shows that you are actually over trading and you are unable to manage your working capital within your company. So these are the importance in terms of working capital. So under working capital, you need to make sure that enough is invested in the assets. So meaning that your assets or your current assets needs to be two times at least your current liabilities, so that even though you repay your current liabilities, you still have enough sufficient assets to run the business operation. So that balance, we call it the net working capital. And we also talk about that when it comes to the high investment in working capital, if it's under your inventory, therefore it also poses a risk to the company. So whoever gets to invest gets to take a look into that and see what risk that this company have posed in terms of its working capital, which is used for its daily operation. So that's part of what we have covered so far, including overtrading. So there is activity number 5 on our textbook. So this is chapter 5, activity number 5. Activity number 5A. So what I'm gonna do is that I'm gonna do a separate recording for this activity so that I can explain everything in detail. I'm gonna try to put it down in Excel and be able to explain this thoroughly with you guys, because it also include missing figures, so that we are able to treat this and understand the importance of working capital and how working capital gets to be done. So when it comes to working capital, we are referring to also the cash that you're gonna need during the whole month. So remember, working capital involve your short-term assets, and your short-term assets, which is your current assets, also include cash. So meaning that we're gonna also focus on the management of cash, where we're gonna take a look in terms of how much cash you're gonna need, how much cash will be going out of the business, and if you're gonna run at a surplus or you're gonna run at a deficit in terms of having cash on hand to continue with the business operation. So those are some of the things that we are going to cover under this activity, which is activity 5A. So I'm going to do a separate recording, so please stay tuned for the second recording in terms of activity 5A. So this will be the end of our lesson, which is lesson number 21. So please stay tuned and watch lesson number 22, which will be the continuation of working capital. But under this point, we'll be starting to take a look at the cash management, which is the cash budget, to see how much cash are we going to need, as well as the outflow of cash. How do we properly plan this? Why does it help us? What are the processes that we have to follow in order for us to be able to achieve our main objective, to maximize our revenue and minimize our cost, which is also maximize our shareholders' wealth, which is the main aim of the running a business. If you are running a profit business or a private business, the main aim is to make money for the owners of the business. Whereas under NGOs, it's just to make sure we create a good image for the company and be able to continue working and operating and supporting those whatever our client might be or our stakeholders. So that is it in terms of today's lesson. So on our next lesson, we'll be talking about cash management, which is also include budgeting. So please stay tuned for the next lesson and enjoy the rest of your time while you prepare for the next lesson.